Welcome everyone to this Primary Markets webinar for the Gladstone Oil Refinery project. Today we're hosting Stephen Turner, who's the Managing Director of Extractive Capital, who's going to obviously take us through the opportunity. Our format has always been and will be a simple one, typically a 10 to sort of 12-minute presentation and then allow a few minutes for Q&A. We like to try and keep it tight to 15 minutes. This is obviously a very detailed project, so just as a note, there is a detailed IM that in support of this presentation and the listing. So a few things might go through a bit fast. Stephen might push us through a few things quite quickly, but there's plenty of detail sitting behind it. And as a reminder, this webinar will be recorded and posted to the platform in the next couple of days. So without further ado, I'll hand over to Stephen and we can get underway.
Okay, thank you, Nick. Thank you very much, everyone, for joining. I'd like to start off, first of all, by setting out what I hope to cover in this short presentation. The first question that normally comes to mind when you look at an oil refinery in Australia is why bother investing in a refinery? Refineries are shutting down. We're down to 4 refineries in Australia, and we're moving to 2 in the next 4 or 5 years. Secondly, how then do we compete against the large refineries out in Asia, which is where we import most of our diesel from? And thirdly, if there is such an opportunity and we can demonstrate that we're competitive, how does that translate into an opportunity for investors to come on board with the Gladstone Oil Refinery? So that's what I'm going to look to try to address over these next few minutes. Okay, the first slide, we can look at the refining industry, and we'll look at the global situation first of all. If we look at globally, what we see is that a lot of the old refineries around the world are closing down. This is driven by advances in technology. It's driven by improved materials, and particularly in automation. A lot of the old refineries are very heavy on manpower. The new refineries, much less so. The changing dynamics around the world, of course, with the rise of shale and oil sand industry is propping up in the USA and Canada. In Western Europe, you have always the advantage of logistics being close to a condensed market. But out in Australasia, what we're seeing is a closing down of the refineries in Australia, 50% decline as refineries have shut down over the last 5-6 years, and more importing in from Asia, from the larger refineries, particularly coming out of Japan, Korea, and Singapore. All right, so let's look at the Australian refining sector specifically. What we see is a number of refineries closing. The key drivers there are the age of the refineries. The refineries over 50 years old. To give you a sense there, the youngest refinery that's still in operation is the Lytton refinery around Brisbane, 52 years old. And the oldest refinery that was built here in Australia was built in 1949, and it is actually, sorry, there's an older one, Shell Clyde, 1928, but the oldest one that's still operating is the Altona ExxonMobil refinery that's 68 years old. The technology has advanced significantly, but I think more importantly, these refineries were built originally to meet the supply of crude that was around at the time. Bass Strait, Northwest Shelf, this is light, sweet crude. The refineries were built near metropolitan centers. If you look at the existing refineries, you've got the BP Kwinana in Perth, the Caltex Lytton one in Brisbane, you got the Altona in Melbourne, and you've got the Geelong, which is now owned by Vitol, also in Melbourne. So they're all located near metropolitan centers. They were designed to produce high volumes or high yield of gasoline to service the car market, and which we call MOGAS, and that has changed significantly in the subsequent 50 years. The market that we see has grown substantially on the back of mining and agriculture. Has been a shift to gas oil or diesel. On top of that, the diesel requirements, the environmental specifications around that have tightened up significantly. So it requires very specific technology to produce ultra-low sulfur diesel. And on top of that, the other issue is the old refineries were built, by being built near metropolitan centers, they also tend to have fairly shallow drafts for ships coming in. So what it's meant is typically product has had to be split into smaller vessels to get it into port, which adds downstream costs. And then even when it gets to port, if you want to take diesel up into central Queensland, you have a heck of a long way to take the product. This has all made the local refineries uncompetitive, and quite frankly, the remoteness for many of the users has also even made imports of diesel expensive, and we'll see that at the gasoline stations, the price of diesel that we're paying. To the next slide. We just make a comparison between refineries. If you look at an export-focused refinery, which is a typical Asian one, they are configured for medium light sweet crude. They typically look for a high product yield of mogas, of gasoline, and the lighter end products. Those typically go into petrochemical units. They get a lot better yields on that. They aren't really designed to produce ultra-low sulfur diesel for the Australian market. In fact, when people do look to import diesel into Australia, they typically have to do special runs, which is a lot less efficient. If you look at the Gladstone refinery, what we're looking at is a refinery that's specifically targeted at medium or heavy sour crudes, which typically trade at a discount. We'll come on to this a little later in the slides, but they trade at a discount to the typical indices of Brent or TAPIS. It is being specifically geared to have a high diesel yield, which meets the environmental requirements in Australia with a 61% yield in the case of Gladstone refinery. So you're looking at a refinery that is being specified for the domestic market. Unlike the big Asian refineries that are designed to cater for multiple off-takers, multiple clients, and quite frankly, diesel is one of the least attractive products that they produce. Okay, so what is the, if we look at how other refineries have been unsuccessful or struggling in Australia, and we look at the successful ones around the world, we take a number of lessons from that, and we've applied that in terms of the Gladstone refinery. One of the key things there is technology. We've been working extensively with the French company Axens in terms of setting the specifications around the refinery to be able to treat the heavy sour crudes, which are trading at discounts, which gives you a competitive edge on the feedstock. The materials are the latest materials in terms of the catalysts and the technology that goes in there. It'll be a modularized design, so we can build it overseas, cutting down on high, expensive Australian labor costs. The site that's been selected has access to deep water port, allowing very large crude carriers to come in, which is different from many of the other refineries around Australia. That's 200,000 ton capacity versus typically a 45,000 ton capacity. So you have significantly economies of scale from one, in terms of being able to bring in larger loads. You have less deliveries, which means less shipping out on the lanes. And on top of that, what we're looking at is a technology that allows the refinery to deal with a whole host of different feedstocks. So not only heavy sour, but it's going to have the capacity to mix and blend a number of different crudes, so it's able to take advantage of pricing differentials in the market. In terms of opportunity, I think we also need to recognize there's been a lot of news in the recently around gas shortages in Australia, about security of energy and supply. It's making the headlines. In terms of products and diesel, we typically only have 14 to 21 days supply in Australia. That's a significant risk from energy security. This refinery, we'd be looking to have a 15-day product supply terminal and 45-day of crude oil supply at site, thereby significantly enhancing security of supply in Australia. This has led to substantial amount of support at the local and national level in terms of investment in the economy, in terms of energy security, and clearly the number of jobs that would be created in the region. If we just move on now and look a little bit more at some of the diesel growth, what we see at the moment is the imports essentially coming from Singapore, South Korea, and Japan. What we have is a rapid growth at the moment in the requirement of diesel and gasoline. So we have diesel growing significantly. We have total products in Australia looking to be imported of up to 80% of the total fuel product demand by 2022 as 2 more refineries close, meaning that we move from 60% imports to 80% imports. And the biggest of these markets are Central Queensland and WA, driven by the resource industries. We just move on to the next slide and we'll look a little bit more specifically at Queensland. What we see is gas oil, or diesel in another name, looking to double over the next 10 years. As I mentioned earlier, the existing infrastructure is inadequate. The terminals and the refineries are a long way from markets, and hence significant downstream costs are incurred getting the diesel to market. We look a little bit narrower in at Gladstone itself. It's been selected through a fairly rigorous process by Casper, the current owner and developer of the project, because of its logistical advantages. It's got access to a deep water port. It's near some major coal basins, and of course we'll have seen in the last few days Adani has announced the green light on the Carmichael coal mine in the Galilee Basin. So what we have is 7 billion litres of gas oil marketable from Gladstone by road. This presents an enormous opportunity for the Gladstone port. And if we look at the site and specifically, there's an extensive process that was done in terms of environmental impact, local support, community, etc. A number of sites were looked at: Newcastle, Wollongong, Townsville, etc. Gladstone was seen as being the favoured one. As I mentioned, one of the big draws, not only proximity to market, but access to a deep water port, which provides significant synergies and economies of scale. The project has secured 200 hectares of land from the government on which to build the site. We're looking at 80,000 barrel per day refinery. It's got the size there of site to increase by 50%. It's also got 25 hectares of land right beside the port, the deep water port, where the crude oil storage will be located. And we'll see that on the next slide. So we've got the crude import terminal and jetty. There will be a 45-day terminal there for crude oil, and then it'll be piped through pipelines that will be put through across this site to the refinery site. This is a industrial site. The advantage there is from an environmental permitting perspective. It's a fairly straightforward process. There's a lot of heavy industry there. It is not a sensitive area in any way. There's no land issues or ownership issues around that. It's all owned by the local government. If we look at the timeline for this project, this is a slightly older slide, and the good news is that some of this has been accelerated. So what we have is we look at the crude and product LOAs or LOIs to be signed. Well, they have been signed. We've got crude supply from a major Russian multinational oil company that has agreed to supply 100% of the crude oil with the blends matching our specifications. But on top of that, we've got a major trader downstream that is signed for both this 100% supply and product offtake. And this is a trader that's recently invested $800 million in the downstream infrastructure in Australia. And we have another major international trader that is also looking to do the same. And that has the benefit of creating effectively a tolling structure for the refinery, in the sense that they would do both supply and offtake, and the refinery would effectively have a collar around the pricing, which means downside and upside would be mitigated and there'd be a steady state set of economics that are effectively underpinned by a multi-billion-dollar company. In terms of the EPC contract, what we have is we have a deal now being signed with CCC, which is a Middle Eastern construction company with a lot of experience of building in these sort of products, tying up with a major Japanese EPC contractor. That LOI is looking to be signed today or tomorrow, and that will have the added benefit of being able to bring in a major export credit agencies such as JBIC of Japan, who would be critical at the funding stage. In terms of environmental approvals, that is well underway. As I mentioned, it's on an industrial site. It's well understood. There's a lot of baseline studies already done. And the result is that we would expect all permitting to be complete within 12 to 15 months from today. And that is when construction would effectively commence and hit the date of what we call FID, Firm Investment Decision. 3 years of construction for the first product. The refinery itself, 80,000 barrels per day, would be 2 units of 40,000 barrels each, with slightly different specifications, allowing a blending of various crudes. It's for those who are aware of the Nelson Complexity Index, it's 9.4, which means it's a refinery with some significant sophistication, and the result of that is its ability to maximize its gas oil yield at over 60%. The total construction cost is estimated about $2.5 billion, and that's something that we would address in 12 months' time, or leading up to 12 months' time through a combination of debt and equity, and we'll come on to that. In terms of the story, it's from a green perspective, it's actually pretty positive. It will offset about 80,000 tons of CO2 per annum versus the competing Asian refineries. This is due to the technology that's being used, reduced shipping numbers, as I mentioned, because of the larger vessels. It's got support from the various governments. You're looking at about 1,800 construction jobs at the outset, and then around 200 permanent jobs thereafter. And just to put that into context, compared to the Australian refineries, particularly those that remain open, they're typically employing 300 permanent people and around 300 contractors. So we're looking at a considerably more efficient refinery going forward. In terms of expenditure going forward, we have development funding. It's set out in various stages. That's against largely obligatory expenditure that we have to do from a permitting perspective and approvals perspective, statutory fees. We're also looking at some additional engineering. That's what the technical commercial is, particularly in terms of converting the existing commercial LOIs and EPC LOIs through to full contracts. On top of that also will be a substantial amount of work working with banks in Singapore in terms of securing the debt facility in place ahead of an IPO. So these costs are all inclusive, but on top of the $15 million, there's the acquisition cost of the project. Extractive Capital has agreed a deal with Casper to acquire 100% of the project for, it's actually $7 million, but $4 million up front, against which they've spent $5 million already, so they're actually out of pocket until FID. And we retain the development team that's been working on this project for the last 5 years and bring that forward so there's no break in continuity there. And then there's an additional $3 million on working capital. If we look at the economic effectiveness of the project, what we can see is a typical, so the typical diesel that comes to market, what it incurs is a landed crude cost, which is the price versus the index. You then have various losses and so forth that get the product to the refinery. So that's where you have the total cost there of $50 odd, and then you have various labor costs and production costs and finance costs, so that what you have is the Gladstone refinery would be able to deliver the product based on 31st of March 2017 prices at about $64. That provides a significant advantage over an equivalent diesel, an import delivery, which would see the price at over $85. So the competitive advantage of the Gladstone refinery vis-a-vis an Asian import as of 31st of March is seen at about $20, okay, which allows us to offer the product at a significant discount to any Asian import coming in. This is the reason we've got two of the largest oil traders in the world, both with significant downstream investments in Australia, competing for the supply and offtake of this product. Because in a market such as the downstream fuel product market, where margins tend to be tight, this offers a significant competitive advantage on 4 million tons of fuel a year. So it's a material amount of their imports and offers a significant competitive advantage. And this is why we have people queuing up to sign up for this.
Yeah. So, Stephen, just conscious of time, there's, as I stated before, there's a lot more information in a detailed IM and around project financial performance, which we probably won't go into now because there's quite a lot of numbers there. But I think it's be very important for people to be able to get in contact with you and talk through that. Just one question's come through is, I suppose, this type of project very much utilising existing infrastructure and old terminal facilities and basically rebirthing them, I suppose, is one way to put it. I'm probably not using the right technical term, but is this been a trend overseas? Are there success stories of this in other markets?
Yeah. Okay. First of all, let's be clear. This is a greenfield. This is not a brownfield. This is not taking on an old refinery and reinvesting in it. This is building it from scratch. This is a modular approach. 2 brand new 40,000 mile per day units that would be built overseas, transported and installed at Gladstone using the latest technology and the latest materials.
Yeah, sorry.
If you look around the world, yes, we are.
What I meant by that was using the I suppose the infrastructure that's already there for a past refinery. I know it's new equipment, it's new facilities coming in, but is that a typical experience overseas?
Well, I don't know specifically about location of new greenfield sites, but what I can say is that there are there's a number of new refineries being built around the world. We just looked at the Petronas one. There's Oman has just signed up another. That's just been in the news. These are refineries of this sort of same size capacity as what we're looking at in Australia. So 120,000 to 200,000 barrels per day is the sort of refineries you're seeing. They are being signed up, and they're being signed up because of the cost advantages that are being driven by the latest materials and technology. So, what we'll see is there's been a lot of work around that site selection, and Gladstone was selected because of its logistical advantages. And I would imagine that any new refinery that's being built in the world would be looking at similar advantages. I mean, the one at Oman, of course, is an export refinery. The Petronas one is an export refinery. So they are slightly different in the sense that they are being geared to multiple products. This one for me has a significant competitive advantage because it is being designed very specifically for the local domestic market, which is more than substantial to service all its uptake. And this is what's driving a competitive advantage. There's an awful lot of costs incurred in Australia on the downstream side. In an earlier slide, and you look at this in the more detailed IM, you will see that there's a large number of add-ons onto your cost of diesel that come from when it lands in Australia just to get to the terminal gate. There's a lot added on. Having a look, there you have it. Thank you. So the downstream costs, you can see it all being added up there. You've got margins, you've got wharfage, you got losses, you've got trucking and haulage, etc. A lot of that has been addressed by locating that refinery in Gladstone near the market. So the selection of the site is undoubtedly critical here in terms of helping to drive that economics. That tied along with its ability to process the less attractive heavy sour crudes, which trade at a discount. So being able to set those specs up from the outset gives it a cost competitive advantage on the feedstock. And then obviously the latest technology on top of that will help drive down costs, particularly from an automation side, because what we're seeing is significantly lower manpower to run this, to operate this on a day-to-day basis.
Okay, fantastic. Look, Stephen, I think we'll need to sort of finish it off there. So there's a huge amount of information here, all very, very positive, and we really appreciate your time today and taking us through the story. There's no other questions have come through on the platform, which is fine. So again, Stephen, thanks for that. Thanks for the presenting. Thanks for taking the question. And thanks to everyone for joining us for this webinar. regarding the Gladstone oil refinery. As I said, it will be recorded and put up on the platform in the next couple of days, and happy to take any further inquiries. So that's all for now. Everyone have a great day, and thank you.